lab. And this is one of the most important technical setups we've been tracking over the last several trading sessions. While many traders are losing interest because the market has been moving sideways, experienced traders understand that periods of low volatility often come before the biggest price movements. Right now, lab continues to trade inside a tight consolidation range. At first glance, it may look like nothing is happening, but the market is quietly building pressure. This type of price action frequently appears before a strong breakout or breakdown. Instead of chasing random candles, we're focusing on the key technical levels that could determine the next major move. If you haven't watched our previous LAB analysis, I highly recommend checking it out after this video, because today's update builds directly on that analysis. The good news is that our original trading plan remains completely valid. Let's begin by looking at the higher time frame structure. On the 4-hour chart, LAB is still trading within the same consolidation zone we discussed previously. Buyers and sellers remain in balance, with neither side taking full control. There has been no decisive breakout above resistance and no significant breakdown below support. When we zoom into the 1-hour chart, the picture becomes even clearer. Price continues to move sideways, creating a series of relatively small candles with limited momentum. Every attempt by buyers to push higher has been met with selling pressure, while every decline has attracted buyers back into the market. Even the 30-minute time frame tells exactly the same story. The market structure has not changed. Instead of trending, lab is simply compressing inside a narrow range. This is actually an important message. Markets spend much more time consolidating than trending. Professional traders understand that patience during these quiet periods often leads to the highest probability opportunities once the breakout finally occurs. Now, let's talk about the most important level on the chart. The key Fibonacci resistance level, around 90 cents, remains our primary area of interest. This level has not been invalidated, broken, or significantly tested since our previous analysis. Because this level remains fresh, it continues to hold strong technical importance. Many traders make the mistake of changing their analysis every single day. They constantly move support and resistance levels based on small price fluctuations. Professional traders don't do that. Unless the market gives new information, there is no reason to change a working trading plan. That is exactly where we are today. The market has not provided any new confirmation. The resistance remains resistance. The consolidation remains consolidation. Our strategy remains exactly the same. Now let's discuss the first possible scenario. Suppose lab begins moving higher over the next few trading sessions and reaches the Fibonacci resistance near 90 cents. Simply touching resistance does not automatically create a selling opportunity. Instead, we want confirmation. That confirmation could come in the form of a strong bearish engulfing candle, a rejection wick with heavy selling volume, multiple failed breakout attempts, or another clear bearish price action signal. If sellers successfully defend this resistance level once again, it would indicate that buyers still lack the strength needed for a breakout. Under that scenario, we would expect another move lower, with our downside target remaining around 9 cents. Of course, this is not a prediction. It is simply the trading plan we will follow if the market provides confirmation. Remember, successful trading is never about guessing. It is about reacting to what price actually does. Now let's look at the opposite scenario. What happens if buyers finally gain enough momentum to break above the 90-cent resistance? This would be a significant technical development. A confirmed breakout would indicate that market structure is beginning to shift from bearish to bullish. However, even then, patience remains essential. One of the biggest mistakes traders make is buying immediately after seeing a breakout candle. Unfortunately, many breakouts fail. Professional traders understand that waiting for confirmation can dramatically improve the probability of success. Instead of buying the breakout itself, we prefer waiting for price to return and retest the broken resistance. If that previous resistance successfully becomes new support, it provides much stronger evidence that buyers have taken control. Only after seeing that successful retest would we begin looking for long opportunities. Under that bullish scenario, our upside target remains around $1.90. That reward potential is one of the main reasons this setup deserves close attention. At the moment, however, neither scenario has been confirmed. This means the smartest decision is simply to wait. Sometimes doing nothing is the best trading decision. Many beginners feel the need to place trades every day. Professional traders know they are paid for patience, not activity. Waiting for confirmation protects both capital and confidence. Let's also discuss the psychology behind this consolidation. Long periods of sideways movement often create frustration. Some traders become bored and enter random positions. Others close good positions too early because they believe the market will never move. This emotional behavior is exactly why disciplined traders often outperform over time. The market rewards patience. The market rewards preparation. The market rewards traders who follow their plan instead of chasing excitement. Right now, LAB is testing everyone's patience. But eventually, this period of low volatility will end. History shows that tight consolidations frequently lead to explosive volatility once enough buying or selling pressure builds. The only question is which direction the breakout will occur. That is why risk management remains absolutely essential. Never risk more than you can comfortably afford to lose. Always wait for confirmation before entering a trade. Always use proper stop-loss placement. And never let emotions replace your trading strategy. As traders, our goal is not to predict every market move. Our goal is to identify high-probability opportunities and execute them with discipline. So, to summarize today's analysis, LAB remains inside the same consolidation range across multiple timeframes. The key Fibonacci resistance around 90 cents remains the most important level to watch. If price reaches that level and produces strong bearish confirmation, we will look for a potential move toward 9 cents. If buyers successfully break above the resistance and the market completes a clean retest, we will begin looking for buying opportunities with a potential target near $1.90. Until one of those two scenarios develops, patience remains the best strategy. Now, I'd love to hear your opinion. Do you believe sellers will continue defending the 90-cent resistance, or do you think buyers are preparing for a major breakout toward $1.90? Leave your thoughts in the comments below and let the community know what you're seeing on the chart. If you enjoyed today's lab technical analysis and want more professional crypto market updates, high probability trading setups, and educational price action breakdowns, make sure to subscribe to the channel, turn on notifications, and share this video with other traders who are following lab. Thank you so much for watching. Trade with discipline, protect your capital, stay patient, and I'll see you in the next market update.